Welcome back everyone. In this video we'll discuss on how to identify breakout structures in the market structures. So now I want us to pay attention to how I'm marking out the charts and how to identify the actual zones where the market broke a structure and the zones where we'll be talking about internal structures and external structures. Now, when you are doing your analysis, there's something we call time frame difference, the difference in time frames, how the market moves. So sometimes your support zone on a particular time frame might not even be a reasonable zone in another time frame. Now, all of us know that higher time frame is always more important when it comes to taking a long-term position trading. But if you are a scalper, you always look forward for a short time frames. Sorry. Now, this is how it goes for you to understand why they use different time frames. Now, when you are doing your analysis, you are using a high time frame, that means you are looking at the bigger picture for investors. Like maybe you are looking at daily time frame, 2 hours time frame, 4 hours time frame, weekly time frame, and so on. Someone looking at the weekly time frame is basically looking at investments. Okay, I want to buy this particular stocks. I want to buy it and keep. I have the belief from my analysis, it shows that this particular stock has a potential. By then you must have looked into fundamental analysis. You understand? But you as a trader, a future trader, stock trader, or forex trader, now you only look at the short terms, and that is why you basically focus more on 4 hours to 1 minute time frame. Now, looking at it now, when you are scrolling from different time frames, you start getting confused because the market structures are not the same. So I will use a ray chart to show us. Before I use a ray chart, I will kind of draft out a structure that will help us to identify how all these things works. So now I will draw a structure, and from that structure, all these patterns, market patterns, market formations, chart formations, all of them came out. If you understand this, how to separate structures, then you will not have issue in that field. So now excuse me guys, so let's start. Now how it goes is, firstly we need to identify, using your support and resistance. I always tell you guys to identify the direction of the market. Then from the directions, you will now start marking out a possible reversion pattern or continuation pattern. Now all these breakout structures you hear, they are used to identify either the market is on a continuation or about to reverse. So let's start now. So well, firstly I will use a normal drawing to explain, then we'll go and do a little practical with the chart, so that, because sometimes you kind of get confused. So now when we see a market making this move, the market move from this zone and go up, then from this zone you see a retracement, and again you see market going up, then you see a retracement, then you see market maybe failing to break the above, then you see a retracement, then you see market coming above, then you see a retracement. Like, I'm just counting all these things so that you can follow it as I'm saying it. The more you follow it, the more it will be easier for you to catch up with the narrative I am bringing into the structures. You understand? So now you may say hi, then come back again, and you see another retracement this way. So now looking at these structures, you see that there is a kind of movement that is kind of confused. But if you look at it, kind of deleting a lot of things in your mind, look at the bigger picture, you will discover that we are seeing a move. This the first place the market hit and reversed, then we had another place that this market hit here and reversed, then we have another place that this market hit here, reversed, then we had another side which is this zone, reversed. Then you will discover that whenever it pulls back, any place it reverse from, we always have a massive pull that is aiming to break above the other zone. So now let me explain to you what just happened in this kind of situation. Now what you are looking at the market is that this market is actually ranging. It is ranging at the upside. Now if you don't know how to identify whether the market is going an upside or downside, you can also go to some of our previous video. I explained it in details. But continuing with the breakout structure of a thing, now in this situation, now we can see that what made it to move at the upside, or what made people to start looking for a buy. In this kind of situation, your primary aim is to go in for a buy, but that does not mean that at times you can't go in for a sell. But going in on a sell is now a high risk. You should just know it within you that, okay, I am taking this risk because of 1 or 2 reasons. So now if you look at this place now, this was a resistance zone, this level was a resistance zone where the market reversed from. Then suddenly the market break a resistance. Now what do we know about support and resistance? Whenever a market break a support or a resistance zone, we expect a retracement for a continuation. You understand? Now this market broke this zone. Breaking it upside have already brings a bullish sentiment into people's analysis. You understand? Anybody analyzing it is looking forward for a bull because the market was coming from down and was able to break above the resistance zone. Then the pullback is a retracement zone. Now there is something I want you to put in mind. Where the market pulls back to is very important. Now, with the law of support and resistance or demand and supply, they always tell you that if you are taking any particular demand zone, make sure that your stop loss covers the previous low of the demand zone. Now, this zone now is a breakout structure, and some people call it, there's a candle here they call a breaker block. Yes, they call it a breaker block. Now that breaker block is the same as your normal order block, but they call it a breaker block because that was the OB or the order block that people were expecting to sell from. Yes, people were expecting to sell it from. So that zone, then the market broke above it, meaning that was where the market liquidated or hit the stop loss of people that were selling. So that means that zone is, that candle is a breaker block. Then some people come in and place another buy on that same order block. Now, why did they do so? When you did your support and resistance, if you don't know much about support and resistance, please try go back and rewatch our videos. Now, this market now moved from this zone, coming to this zone, rejected it, coming back. People tend to sell it again so that it can make like something like a double top. You understand? But suddenly the market broke above. Now, breaking above, the analogy of support and resistance says the market will come back to retrace to this zone and go higher. You understand? So if you are bringing it back to breaker block that they are using, which is mostly people trading SMC and ICT, they always call it a breaker block. The reason you see some of them taking that candlestick or that order block out, marking it out for their place of buy, was a foundation, or should I say an analogy that was derived from the support and resistance or demand and supply concept. You understand? So that was how this one came about. So when they mark it out, they expect the market to retrace their zone. Then their stop loss, sometimes they will measure 50% of this zone and place their stop loss below 50%, or from here to this zone, from this zone to this zone. That is what they do most of the time. But now, bringing it in a normal sense with the typical analogy on how to analyze that structure. Whenever the market, let me use this place, whenever the market breaks structure their way and is coming back for a retracement, and you decide to take the trade. Now, I want to mark out places for you. From this zone, and this zone. These three zones is these possible places the market can reverse from. Now, let me explain it. Now, the reason why the support and resistance gave you the analogy to close, make your stop loss to be below the previous low, is because from this zone to this zone is our area of demand where people will buy from. Now, why did I put two blocks? This place is the breaker block. This is the 50% of the movement in the market, which most of the time the market always retraces to 50%. Then the last one is the liquidity level, which the market, you always know, the market tries to clear the liquidity or hitting stop loss of people that took this zone and this zone. So most of the time, the market actually misses this zone. But if you are trading something like gold, be careful. If you are trading something like BTC, be careful. Now, I don't want to divert. Let's focus. In the next videos, I'll explain how different coins or different stocks or different currencies moves. It's not the same. You see, the movement of GBP USD is different from the movement of GBP JPY, and it's different from the movement of Euro GBP. You understand? So you need to understand how it moves. Like something like gold does not joke with imbalance. Yes, gold does not joke with imbalance. Most of the time, gold always hunts imbalance. So now, let's continue. At this level now, when market makes this zone, what you see people normally do, the right thing to do is that you place your entry here and hunt your stop loss to be below this zone. Now, but there's a reason why people stop doing it, and that is why your mentor will not tell you the main reason why they are not taking that side. Now, the reason why they are not taking it, the reason why they are not taking that level is because when they make this move, the stop loss is too wide, which you cannot afford to lose that much. And that is why you see people with big money. You see all these people you see online advertising, like successful traders, like highly successful traders, you understand? People that can trade with $1 million and it doesn't shake them. You will see that once they see the market are broken above, and they definitely, their analysis shows this market will buy, they will just jump in. Their stop loss is enough to cover even far below. So if the market the market can come here and play along, do the rubbish it feels like, and still buy. But you that you are just trading with $1,000, you cannot afford that movement. You can't risk it. And that is why some of you want to pay for signals. You don't just understand how the person you're paying for is trading. That same person is someone that when he makes 10 pips is over $1,000 for him. But you that is here, your 10 pips is not even up to $1. You understand? So always pay attention and understand the analogy. And I always tell people, whenever someone is giving you a signal, tell the person to send his chart. There is a reason. So now, because their stop loss cannot cover it, then they now brought another analogy. Now, what they normally do now is that when you are placing this zone, when you are placing at this zone, there is always that candlestick, that breaker block you saw. There is always another candle that is beside it that kind of released the wick. That wick was used to clear the other block you marked out. You understand? To clear the liquidity. So what they do is that, what we normally do is that you now place your stop loss below that wick of that candle. When we go to chart, we'll do it practically. We'll see how it works. That is if you are taking this zone. Then if you are taking the second zone, you do the same thing. If you are taking the last zone, then you can now willingly secure the perfect zone for your stop loss. You understand? That is how it works. So in the next video, watch out for the next video for continuation. Thank you so much, guys. Make sure you watch the next video.